Welcome to the Contrarian Capitalist podcast. I'm delighted to be joined today by Craig Hemke. You might know him from the Sprott Money podcast, but also of the TF Metals report over on X as well. Craig, thanks for taking the time out today to have a chat.
Rob, it's a pleasure to get to know you, and I'm happy to visit. Thanks for the invitation.
We've got loads to speak about. I think the best thing to do, I don't always like date stamping at the start, but obviously a lot happening this week. So we're recording this on the 1st of April, should be out on, or this will be out on the 3rd of April. I just wanted to get your overview of the gold and silver markets first, before we have a little dive into some of the OI numbers that you discovered or people have discovered recently, and what that means moving forward. But a 30,000 foot view of what you're seeing so far in the bullion markets, if that's okay.
Well, it's been a very busy year. It was very busy last year. I thought we'd rally last year mainly based on economic weakness in the US and lower interest rates, and we got all of that towards the end of the year, but price just, exceeded everybody's expectations. And at the end of the day, I think a lot of that was due to just 3 straight years of central bank gold demand, which by the time we got the 2024 numbers showed a net total demand of about 3,500 metric tons. And I think that's kind of stressing the physical market in London a little bit. With the election of Trump, we started to see some weird happenings between the spot price and the futures price, a big spread between the two that would normally be closed by an arbitrage trade where you buy the spot and sell the futures. And that just wasn't happening beginning in December, and it persists to this day. We've then seen, reports of 700 metric tons, reports as many as 2,000 metric tons of gold leaving the UK and coming over to the US. And I think this physical demand is what is driving price, and drove it last year,
Hmm.
drove it again this year. So far this year, we just ended the first quarter was just dynamite. Almost a 20% gain in the gold price just in the first quarter. Probably not going to continue. If we keep doing that, we'll be at, $5,000 or so by the end of the year. That's probably not what's going to happen. We're probably due for some consolidation, but underlying physical demand seems to be not only supporting price, it seems to be causing some problems in the physical delivery market as well, with the big reports of delays in London and the like. And so all of this continues to ripple around, has my attention, and fortunately, it's been leading to higher prices.
It's been a very entertaining space, shall we say, so far. As you say, we finished Q1 yet. Well, again, when we're recording, we finished Q1 yesterday, and yes, yeah, yeah, every day seems to be an all new time high. I look at moving forwards. I mean, I'd expect, just given seasonality, that my understanding is that normally, April to July, normally, I mean, it could go sideways. I'm talking about gold here, could go sideways, and then I think it's after the 4th of July, if I'm not mistaken, up until October, November. That's quite a seasonal good time for gold. So, but again, there's so many economic bits and bobs happening. We've obviously, in between recording and this coming out, it's Liberation Day, and I use that term loosely. Who knows what's going to happen there? What's your sentiment for the markets moving forward?
Well, we have had this just tremendous run in gold. And with any bull market, and we've seen this in gold over the last, what's it been, 13 months that it's been rallying. I think broke out back on March the 1st last year, finally got above 2,100 and then went to 2,400. And in this run, we've had periods of consolidation, lasting a couple weeks, lasting a couple of months. A chartist would call it a bull flag, or a consolidation period on the chart, and we've seen that, and that's typical of bull markets. You get to the point where momentum kind of peaks out. Over here on the Comex, where we have hedge funds and the like that trade Comex futures contracts, you get to the point where, in the simple, it's an oversimplification, but it's like everybody is bought. And once everybody that's going to buy has bought, well, all of a sudden you have more sellers and buyers, and you get into this corrective phase. Um, that typically, the market kind of rolls over, the momentum fades, maybe you take out the 20-day moving average, and then that leads to some more, technical based selling, and then you threaten the 50-day moving average, that kind of thing. But all that's doing is setting the stage then for the next leg up. And so we're probably due for another one of those. I don't know. Maybe not. Yeah, I'd love it if we just kept charging forward, but that
Mm.
typically not the pattern. I don't know, the other news, all the stuff about tariffs, and what the US is going to apply, to things like copper and steel and aluminum and how that ripples across the commodity markets. That's going to be an ongoing story here in April too. So we'll see. Again, we should expect pullbacks. The duration of them will be the part that is in question. And then from there, again, I don't think that we really see a breakdown and all of a sudden like a bear market in the metals. But we'll have to, always have to be alert for that sort of thing. That's for sure.
Yeah, especially if this big recession that people keep, indicating could happen, will happen, however you want to frame it. I mean, that should that happen, that will likely take everything down with it, but it would be the what I would call the bounce back ability of gold, silver, to then, really have that next leg much higher. So I wouldn't be surprised if everything gets taken down initially, but certainly the rebound aspect of the metals would be, I would imagine, quite strong moving forwards.
And we've seen some of that as the equity markets in the US have been weak over
Mm.
the last month or so. A lot of times intraday, the stock market's going down. And it just kind of leads to a follow-on. Heck, as we were recording this on the 1st of April, we had some of that this morning. We had some of this yesterday morning on March the 31st. Stock markets open the week, and about that exact same time, gold and silver futures get weak. It's almost not necessarily like we're at a margin call, got to sell whatever I have whatever has a bid to raise some cash. But it's just kind of a caution. I think you can also kind of see this play out in the mining shares as well. A lot of
Mm.
people wondering, well, why the heck isn't, some of the GDX doing better or some of the big mining shares doing better? Um, and I almost get the sense that it's in general, I'm just a little nervous about all this. And rather than taking some of my positioning out of growth and moving it into the value of the mining shares, just take some money out of growth and sit on the sidelines for a little bit. And it hasn't been a sharp pullback in equities, but it's been in general equities, but it's been a gradual pullback, just suggesting people are a little bit cautious, looking at things. So as you said, though, if it gets consistent and persistent, it can lead to a consistent and persistent pullback in the metals as well. So we've got to keep an eye on it.
Yeah, there's a lot to keep an eye on, and obviously it can go in either direction. Who knows? I think at this stage, Craig, I just wanted to, and if you can, if you can do this as layman as you can, because I never like to make assumptions that people listening to the podcast know everything about everything. So sometimes I like to, go back to the very basics in layman's. So if you don't mind with the
Mhm.
following, there were some very interesting numbers on the open interest, Comex related matters, on not just on gold, on silver, and even platinum. So, if you don't mind, in as many layman's terms as possible, what does this mean, and what do you think is indicating what's happening behind the scenes there?
Well, I mentioned the spread between the London spot price and the New York futures price that hasn't been getting close since December. It varies, it goes down and widens up again. And then in early February, there was a story in the Financial Times of London that said there's now 4 to 8 week delivery delays
Hmm.
in getting metal out of the LBMA vaults, which it should be like a day or two. So that begins to get everybody wondering about, is there tightness and delays out of London? And so does that mean that there's going to be tightness in other markets around the world? And, if you can't get metal out of London, are you going to come to a place like New York and the Comex and try to get metal there, which it's not designed as a delivery market? I mean, Comex maybe delivers 0.5% of their total amount of futures contracts, that open interest you mentioned, every other month. But that started to change too. The month of February, the calendar month of February, was a month where the Comex would deliver against contracts. Okay. Not not like to the extent of London, where they do, however many metric tons annually. Comex would normally in a normal February maybe deliver 10 or 20,000 contracts at 100 ounces of contract. We're talking a million to 2 million ounces. Well, suddenly in February, there were 60,000 contracts that appeared to be standing for delivery. And by the time the month was done, they did nearly 80,000. Okay, so it's like, okay, let's connect these dots.
Hmm.
You got a big long wait time in London. Now all of a sudden are, people that need immediate delivery, are they coming to New York to get their metal? Maybe. So the next, what we call delivery month on Comex is April. That contract went off the board and into its delivery phase back on Friday night. So I was very keen to see how many contracts were still open. Remember, I said there were like 60,000 for February at the end of January. Well, there were reported to be 55,000 in April. And okay, great. This trend continues. Okay, this is going to play out almost the same as February. It's been very supportive of price to have this kind of demand for metal like that. So that was good. Well, okay. The thing that really got my eye that you're referencing is on Monday, suddenly the open interest report from the CME said, no, it wasn't 55,000, it was 106,000. You know, whoa, wait here. If that's true, then this really is an acceleration of people desperate for metal anywhere because they're not getting out of London, 4 to 8 week delays. So now they're coming to New York and getting it out. Well, I got on the phone right away, called the CME group and said, what, can you confirm this? And I got a guy on the phone and he was checking sources. He's like, yeah, sure looks, that's the number we have. Wow. Well, I'm going to wait until Tuesday morning to see if it verifies with the next day's report. And as it turns out, it didn't verify. They rolled the numbers basically right back to where they were, closer to 50, 55,000. So it looks to me, even though it was expressed, as you said, big jump in silver, big jump in platinum as well.
Hmm.
And maybe there's shenanigans going on behind the scenes. I don't know. But I'm gonna 15 years of doing this, this website I run for 15 years. I'm gonna fall upon it was just a screw up. It's like every once in a while, we saw this last night too. All of a sudden, the yield on the US 90-day T-bill prints at like 4.9%.
Hmm.
And everybody takes to Twitter and says, oh my God, the bond market is seizing up. Well, you know what? Actually, it's probably a mistick. And lo and behold, a couple hours later, it's 4.4% again.
Mhm.
And it was. And that's what I think this. Now, look, I'm partially to blame for this. I was the one that went to Twitter and said, whoa, what's going on here? 106,000 contracts. But I also told everybody step by step, I'm on the phone with the CME. Let's wait until, Tuesday and all this stuff. And now it appears that now, at the end of the day, the month of April is still going to be a very busy amount of deliveries. They may still do three, or I'm sorry, 6 million, 7 million ounces of gold, which is still extraordinary for a market like the COMEX, way more than the historical average. And indicative of this trend of, people trying to find metal wherever they can, whether it's due to tariffs or whatever. But it's not quite the emergency stage yet that I was wondering yesterday at about this time. Sorry, that was a long answer, Rob. I apologize, but I tried to kind of condense it as best I could.
No, no, really appreciate that, Craig. I mean, that's the whole point. That's why we enjoy doing, these podcasts, and I refer back to the Sprott podcasts that you do as well. I enjoy listening to them because they're 25 minutes, half an hour. They get to the point, and I think everything's explained quite well. So I appreciate you taking the time out to explain that. So in a nutshell, we've got a bit of a misprint. The general trends are
Mhm.
still the same. April's going to be a busy month, and then
Yes.
I think there's enough economic factors in general to this isn't even if it's a bit sideways for the next few months. And barring a big recession where there could be a pullback, or there will likely be a pullback across all sectors initially, we're in a bull market, and that's where we are. So, and there's a lot of economic uncertainty, a lot of war prospects in Europe, and I say that, I don't say that lightly, because it's not good. And I know that Rick Rule always says that, along the lines of, the higher the gold price, normally means we're not in a great situation. So he doesn't, want gold to go, extremely high, but this is where we're at the moment.
Right.
I never like to ask people for predictions, so I think that's a bit too cheesy. But I always like to ask, with everything that you're seeing at the moment, um, what do you think the future's going to look like for gold and silver? Do you think that there will be, the US will monetize the asset side of the balance sheet? Is gold going to get revalued? Are they doing all this because they need and want that gold price higher? I know that you do a fantastic annual report, but a bit more meat on the bones if you can, Craig.
Well, I write that report every between Christmas and New Year's every year to kind of look ahead. And I do it mainly just so I have a record of what I was thinking, because invariably I'm going to get a lot of stuff wrong. And I want to be able to go back and go, okay, oh, that's where I messed it up. Okay, so I can learn myself. Last year, I thought we could get to about 2,300 in gold. We went to what, 27 or 2,800. And again, and in looking back, I think what I failed to fully factor in was this ongoing central bank demand that's kind of putting a physical floor under price, keeping price from correcting sharply.
Hmm.
With that in mind, I thought, okay, why not? I thought we'd get above 3,100 at some point this year, and then probably extend, and then probably hover around that number. That would give us kind of an average year. Um, Obviously, we've gotten past 3,100 already, and it's just the end of the first quarter. Could we keep going from here? And a lot of that, I think, depends upon what you mentioned, Rob. This wild card that was thrown on the table in early February about, is the US looking to monetize the asset side of the balance sheet, revalue gold to some other number. And if they were to do that, it's basically an accounting gimmick, which would allow the Trump administration to issue another, I don't know, $1 trillion worth of debt, or $2 trillion worth of debt or something, in kind of a total deficit neutral way. Well, we upped the asset side by 2 trillion, so now we're going to up the deficit side by the liability side by 2 trillion. Same number, but now we got $2 trillion that we can, buy our Bitcoin with, or fund a sovereign wealth fund or something like that. I don't look. This has not happened in my lifetime. I mean, the U.S. has pegged their gold at $42.22, since well before I was born in 1966. So I don't know what the impact would be on price if they did. If they came out and said, we're going to call it 3,000, we're going to call it 5,000, whatever, in this accounting gimmick. I don't know what that would mean for price. It does seem, though, to connect that, all of this gold that's coming back across in the US, ostensibly for tariffs and to protect the Comex. Some people say it's 700 tons. The StoneX group out of London says it's 2,000 tons. Maybe they're plowing the field a little bit. Maybe they're shoring up and repatriating US gold so that we've got it all here before they do something like that. So these are all, wild cards that are in my mind, in running a precious metals site every day, trying to, connect all these dots to kind of see where it's going. Even outside of all that, Rob, even if none of that happens, I think we're going to have pullbacks, and we may be, starting one now as the second quarter begins. But the U.S. economy seems to be demonstrably slowing. The last 6 or 7 times that the U.S. have had an inverted yield curve, the recession has begun once the yield curve uninverts and has a positive slope again. Well, that happened late last year. And now, we've got all these other signs of a slowing job market, slowing manufacturing sector, all this kind of stuff. The Fed was talking about 2 rate cuts. The market's starting to price in 3. I think there's every reason to think that even with all this other stuff going on, just getting back to the traditional, what drives the gold price,
Hmm.
we're probably looking at a gradually, consistently weaker dollar through the last 3 quarters of this year, gradually, consistently lower interest rates through the final 3 quarters of this year. And you put that back together, that should lead to at least gradually increasing gold prices and silver too. So that, does that mean we can be 33, 34, 3,500 before the end of the year? Yeah, maybe. And then who knows what all, these other things could impact price, bigly, as Trump would say, in the meantime.
Yeah, I think it's a very exciting space to be in. We haven't even really touched. I know you referred to the GDX. We haven't really touched on miners. I appreciate. I think that's probably a good place to leave it. I think there's a lot of information there for people to take away. In a nutshell, it's been a good quarter one, shall we say? A lot of different factors at play. I mean, I'm not allowed to give financial advice or any recommendations. I always like to say to people, if you're yet to have a position in physical metals, do your own homework, listen to these podcasts, read books, make your own decisions. It's never too late until it's too late. And there's not even much, if any, retail interest, certainly in the West at the moment. So
Right.
if you do jump on board, it's still not a bad time, in my opinion, to do that. I'm sure that's a sentiment you'd agree with as well.
Yeah, Rob, that's what my site's all about, is accumulating metal ahead of what we call the great Keynesian experiment ending. This debt-based monetary system being stretched too thin. I always put it this way. I've referenced central bank demand multiple times. These global central banks, what are they doing? They're taking their dollar reserves or any foreign currency reserves, and they're converting it into gold. Not all of them. They're not draining they're not putting all of their assets into gold, but a part. And they're doing it consistently now, 3 years in a row. Well, heck, that's all you and I are talking about here.
Mhm.
What are our what my dollar reserves are my savings, right? And I hold them in dollar-based assets, and you probably have some in your currency, right? And so if the central banks are doing this, why wouldn't the people on my side or the people listening to you and I think, well, maybe that's kind of smart. I should take some of my accumulated savings and buy some gold too. Not, you don't cash out everything. That's not what the central banks are doing, but you take some.
Mhm.
It would seem logical. They probably have some idea what's coming. So maybe we all individually should be acting that way too.
Yeah, do as they do, not what they say. As I'll probably have
Yeah,
paraphrased that
right.
really
Good
badly.
point.
Yeah, just look at what they're doing. Craig, well, I appreciate you taking time out today. I think it would be great, maybe later on in 2025, we have round two and maybe look more of the lay of the land. Then maybe touch a bit more on miners and other aspects as well. If people want to find you, get in touch with you, obviously, TF Metals on X, any other places that people can find and connect with yourself?
Yeah, you can follow me there at TF Metals on X. That obviously is free. I just it's amazing how many followers I have. It's just mind blowing. But whatever. But my actual business is this site, tfmetalsreport.com. It has been live now for about 15 years. There's a subscription component because I do a lot of analysis every day and record podcasts every day, but it's only 15 US dollars. So it's not like it's some exorbitant, crazy cost, but I have to make a living at this. So it's 50 cents a day, 50 US cents a day if you want, a whole bunch of analysis all day long trying to make sense of all this stuff and putting it into our shared language of English. Anyway, I invite people to check out. It's a great community of people globally that are all concerned about the same stuff. Just right there, tfmetalsreport.com.
Fantastic. And for those listening on podcast format, if you go to contrariancapitalist.substack.com, the post that comes with this podcast, I will have all those links in there as well. And if you're watching this on YouTube, just looking at the description, the links will be in there as well. Oh, Craig, thank you for your time. I learned a lot there as well. So thank you for putting a lot of that into layman's terms and look forward to catching up later on in the year.
Rob, it was a pleasure. Great getting acquainted, and feel free to call anytime.